Want to invest in a startup but not sure how to begin? Or maybe you've already taken the first step, but you're looking to improve the way you find and close deals. You're in the right place. In this video, we're breaking down how to invest in startups, step by step, with no jargon and no guesswork. Whether you're curious about angel investing, crowdfunding, or just figuring out how it all works, we've got you covered. Part 1. Why invest in startups? So, why do people invest in startups? Well, startups offer a chance to get in early on the next big thing. Think of companies like Uber, Airbnb, or Canva. Startup investing can lead to massive returns, but it's also risky. Most startups fail, but the ones that succeed can grow your investment 10x, even 100x. That's why understanding how to invest, not just where, is crucial. Part 2. Ways to invest in startups. There are several ways to invest in startups. Let's look at the 3 most common ones: angel investing, crowdfunding, and venture capital. Angel investing. Angel investors are private individuals who invest directly in early-stage startups. They often invest their own money and bring more than just cash. They bring experience, industry contacts, and mentorship. Angel investing usually involves higher minimum investment amounts, but also the potential for more involvement and higher returns. Crowdfunding. Crowdfunding is where lots of people each invest small amounts into a company or project. Think of platforms like Kickstarter or Seedrs. You can start investing with as little as $10 or $20. The company raises a large amount of capital by collecting from the crowd, and you get a small share or perk in return. Venture capital, VC. VC firms invest larger amounts into more mature startups. This method is less accessible to the average investor unless you're part of a fund or a professional network. In this video, we'll focus mainly on angel investing and crowdfunding because those are the most beginner-friendly. Part 3. Angel investing. How it works. Angel investing sounds exciting, but how does it actually work? Let's break it down. Step 1. Find the right startups. Start by looking at startup directories, pitch events, and angel investor networks like AngelList or Seed Invest. Evaluate the startup's team, business model, market size, and most importantly, traction. Does the company already have users or revenue? That's a good sign. Step 2. Understand the terms. Before investing, you'll get a term sheet. This document lays out what you're getting for your money, how many shares, what kind of rights, and more. You don't need to be a lawyer, but it's smart to understand the basics or get legal advice. Step 3. Make the investment. Most angel investments are made through online platforms or directly through the startup. You'll transfer funds, sign documents, and officially become a shareholder. From there, it's a waiting game. Most startups take years to grow and exit. Part 5. Risks and rewards. Let's talk about risk. Investing in startups is not a get-rich-quick scheme. Most fail. That's the hard truth. But the upside? It only takes one winner to make up for all your losses and more. The key is to diversify. Don't put all your money into one company. Invest smaller amounts into multiple startups and increase your chances of hitting a big one. Let's break that down. Say someone you barely know asks to borrow $50 and promises to pay you back $60 in 2 weeks. That's a bit sketchy, right? The extra $10 doesn't feel worth the risk. But what if they offered $100 back instead? Yay! Now you're risking $50 to potentially double your money. Yeah! That's a 1.2 risk-reward ratio, and that's when smart investors start paying attention. The higher the reward compared to the risk, the more attractive the deal becomes. If that person offered $150, now it's a 1.3 ratio. You're risking $50 for a chance at $150. That is even better. Now, let's apply that to the stock market. Imagine you find a stock, let's call it XYZ, currently trading at 25. You've done your research and believe it could bounce back to $20. You invest $500 and buy 20 shares. But here's the big question. Do you know your risk-to-reward ratio? If you're like most beginners, you probably don't. Understanding this ratio is key, because in startup investing, just like in stocks, you're not just buying potential, you're buying risk. And if you're going to risk your hard-earned money, make sure the reward makes it worth it. Startups through VC funds. Want to invest in startups but don't have the time or expertise to pick winners yourself? That's where VC funds come in. A venture capital fund, or VC fund, is a pool of money from multiple private investors. That pool is managed by professionals, called venture capitalists, who invested in early-stage startups with big growth potential. Think of it like this. You're handing your money to startup experts and they do the heavy lifting, research, deal-making, and decision-making on your behalf. Venture capital is a type of private equity, which means it's not traded on the public stock market. It's high risk, but it can come with high rewards, just like when Harvard professor Georges Doriot turned a $200K VC investment into $1.8 million back in 1955. VC funds have powered some of the world's biggest companies, especially in tech. In fact, by the 1990s, nearly half of all venture capital was flowing into Silicon Valley. So, how do VC investments actually work? First, startups submit a business plan to the VC firm. If the firm likes what they see, they do a deep dive, called due diligence, into the company's team, product, and strategy. Then comes the investment, usually in stages or rounds, where the firm gets equity or ownership in return. Finally, the goal is to exit, usually 4 to 6 years later, when the startup is sold, merges, or goes public with an IPO. Investing in a VC fund means you get access to this high-stakes world, but with pros managing the risk. It's not for everyone, but if you're looking for exposure to big ideas and even bigger opportunities, VC might be your path. What is an IPO? Ever wondered what it means when a company goes public? You've probably heard the term IPO thrown around, but what exactly is it? IPO stands for Initial Public Offering. It's the first time a private company sells its shares to the public on a stock exchange. So technically, once a company goes through an IPO, it's no longer a startup. It becomes a public company. So why do companies go public? Simple. Money. An IPO helps a company raise a large amount of capital, fast. That money can be used for expansion, product development, hiring, or even paying off debt. It's also a moment of reward. Early investors like founders or venture capitalists can cash out and finally realize the gains from their investment. But here's the thing. An IPO isn't just a flip of a switch. It's a long and complicated process. First, the company hires investment banks, known as underwriters. These banks help with everything: preparing legal paperwork, filing with the SEC, setting a price for the shares, and even marketing the IPO to big investors. This whole process includes what's called a roadshow, where company execs meet with potential investors to generate interest. Now, before the IPO, a company is private. Its shares are owned by a small group: the founders, employees, maybe some venture capital firms. But after the IPO, those shares are traded publicly. Anyone, you, me, or any investor, can buy or sell them on a stock exchange like the NYSE or NASDAQ. The moment that trading bell rings on IPO day, the company's private shares become public, and their value is set by the open market. Most companies consider going public when they've hit major growth milestones, often with a valuation around $1 billion. These are what we call unicorns. But it's not just about size. A company must also prove its profit potential, transparency, and stability to meet the exchange and SEC requirements. And for the company, going public brings not just money, but credibility. A public listing can help secure better loans, attract top talent, and raise its reputation on a global scale. So, next time you hear that a company is launching an IPO, you'll know it's making the leap from private to public, opening its doors to investors everywhere, and starting a brand new chapter in its growth journey. What are bonds? Ever heard someone say they're investing in bonds and wondered what that really means? Well, here's the simplest way to think about it. When you buy a bond, you're lending money, either to a company or a government. In return, they promise to pay you back with interest after a set period of time. So, what exactly is a bond? A bond is a fixed income investment. It means you earn a predictable amount of money, called interest, over the life of the bond. Then, when the bond reaches its maturity date, you get back the original amount you lent, also known as the face value. Think of it like a loan. You're the lender, and the government or company is the borrower. Bonds are everywhere. Governments use them to build roads, schools, and infrastructure. Companies use bonds to grow their business, like expanding, launching new products, or hiring more staff. When you buy a bond, you're not buying part of the company like with stocks. You're becoming a creditor, someone the company owes money to. Bonds come with key details: the principal, how much you're lending, the interest rate, also called the coupon rate, and the maturity date, when they'll pay you back. Most bonds are issued at $1,000 per bond, but they can be traded at different prices depending on a few things: the company's credit rating, the length of time until maturity, and what current interest rates are doing in the market. Here's something important to remember. Bond prices and interest rates move in opposite directions. If interest rates go up, bond prices usually fall. If rates go down, bond prices tend to rise. Why? Because new bonds may offer higher interest, making older ones less attractive, unless they're discounted. Bonds are considered safer than stocks, but they're not risk-free. If the company or government issuing the bond can't pay you back, that's called a default. Still, for many investors, bonds are a steady way to earn income while helping fund important projects around the world. So whether you're saving for the future or just learning how money works, bonds are a solid piece of the puzzle. Now you know, with bonds, you're the bank, and you get paid for it. What are private equity trusts? You've heard of venture capital, but what about private equity trusts? They sound complex, but don't worry, we'll break it down in simple terms. A private equity trust is a way to invest your money in private companies. But instead of picking those companies yourself, you invest in a fund that does it for you. Just like with VC funds, these trusts are managed by professional firms. They pool money from multiple investors, usually large institutions or wealthy individuals, and use that money to buy shares in private businesses. These funds typically invest in companies that aren't listed on the stock market. We're talking about startups, fast-growing private companies, or even businesses that are struggling and need a turnaround. The goal? To improve the company's performance, whether through new leadership, restructuring, expanding operations, or developing new products, and then eventually to sell it for a profit. Private equity firms don't just invest, they get involved. Often they take a controlling interest, meaning they can steer the company in a new direction to increase its value. Some funds may also choose to make minority investments in promising startups with high growth potential. One important thing to know: unlike public investments, private equity trusts aren't regulated like mutual funds. They don't have to publicly disclose everything, and they aren't registered with the SEC. That means less transparency, but also more flexibility for the fund managers. So why do investors choose private equity trusts? Simple. They offer access to companies you can't invest in through the stock market, and they often target higher returns than traditional investments. But they also come with higher risk, longer time horizons, and usually require more money to get started. In short, private equity trusts are powerful tools for serious investors looking to play a more strategic long-term game. They might not be right for everyone, but if you want to go beyond stocks and bonds, this could be a door worth opening. The benefits of investing in startups and how to get started. Thinking about investing in startups. You're not alone. With the right approach, startup investing can be both financially rewarding and personally fulfilling. In this video, we'll break down the benefits of angel investing and guide you through the step-by-step process to get started. Part 1. The benefits of investing in startups. Startup investing isn't just about making money, it's also about supporting innovation and growth. For startups, angel investors provide crucial capital to help the company grow, offer guidance, mentorship, and real-world expertise, open doors to future funding and opportunities. For investors, the benefits are just as exciting. You diversify your investment portfolio. You may qualify for tax relief depending on your country. You support bold ideas that can drive real-world impact. You build a powerful network in the startup and investment community. And yes, you can make a significant return on investment if the company succeeds. Part 2. How to invest in startups. Step by step. Step 1. Educate yourself. Before you dive in, learn how startup funding works. Explore industries you're interested in and understand where the market is heading. The more informed you are, the better decisions you'll make. Step 2. Know what to look for. A good idea isn't enough. Look for a compelling vision with a unique edge, a strong founding team with passion and experience, big market potential, a product or service that can scale, a solid, scalable business model, signs of traction, like early customers or partnerships, a real competitive advantage, a clear growth roadmap, and finally, investor-friendly terms in the deal. Step 3. Decide how much to invest. Angel investments typically range from $10,000 to $100,000, but you can start smaller. What matters is understanding your own budget and risk tolerance. Step 4. Be clear on your strategy. Ask yourself, why are you investing? Is it purely for financial return? Or do you want to support innovation, climate tech, or social causes? Define your strategy. Why you want to invest, how much you'll invest, your risk tolerance and investment time frame, what industries or locations you care about, and whether you want to be actively involved or just invest and watch. Step 5. Talk to the founders. Startups are driven by people. Talk to the founders. Understand their vision, mindset, and experience. Do you trust them? Do you align on values and goals? That's essential for a strong investor-founder relationship. Step 6. Assess the startup. Take a 360-degree look at the company. Are the founders credible and committed? Is the idea innovative and solving a real problem? Do they have valuable intellectual property? Do they have a strong, well-thought-out business plan? Look for traction, customer interest, or early revenue. These are all signs they're headed in the right direction. Step 7. Estimate the company's valuation. Finally, you need to know what the company is worth. Use tools like comparable company analysis or discounted cash flow, DCF, to assess a fair valuation. This tells you how much equity you're getting for your money and helps you avoid overpaying. Final thoughts. Investing in startups can be inspiring, lucrative, and impactful if done right. Take your time, do your homework, and look for companies and founders you genuinely believe in. And remember, you're not just investing in an idea. You're investing in people, progress, and the future. Closing and next steps. So, what did we learn? There are multiple ways to invest in startups, but angel investing and crowdfunding are the most accessible for beginners. Do your homework, understand the terms, diversify your bets, and remember, this is a long game. If you're serious about investing in startups, follow platforms like AngelList, Seedars, or Crowdcube, and keep learning. Read term sheets, join communities, and track your investments over time. Want more videos like this? Don't forget to like, subscribe, and drop your questions in the comments. Thanks for watching, and good luck on your startup investing journey.